Hi everyone. So thank you for joining us and welcome to our webinar, a legal and tax deep dive into sweat equity and startup valuations. So I'm Georgina Toomey and I'm a practice group leader in the corporate team at LegalVision. And I'm really pleased to be joined today by Mark Lodder, who's BDO's national tax leader. So thank you, Mark, for joining us today.
Afternoon.
So before we begin, we will run through our usual housekeeping matters. So firstly, you'll be emailed a copy of this webinar recording later today. Mark and I will also be doing a Q&A at the end of the session. We may also just build in the Q&A to our discussion as we go, if it's relevant. So if you do have any questions, then if you can submit them in the chat box, that would be great. Now, we'll also have a survey that's circulated after the webinar. I'd be really grateful if you could complete that as well, which just helps us make sure that our webinars are tailored to our audiences and of benefit, of course, to you. Now, all attendees are also encouraged to reach out for a consultation with LegalVision after the webinar. In that consultation, we can discuss your specific sweat equity arrangements or any other legal needs, as well as how LegalVision can assist you in the future. Now, to request that, you just need to provide us with your contact details in the survey that appears at the end of the webinar. Now, as a flag as well, if you do ask a question that doesn't get specifically answered by us throughout the webinar, it's likely that it was just very bespoke to you. So I do encourage you to set up that consultation and we can answer that for you in the consultation afterwards. So now to the content portion of the webinar. So I'll start today by basically setting the context for our discussion. So I'll give you an overview of sweat equity arrangements, different options for sweat equity, and some high-level risk mitigation strategies when you're making decisions around how to structure the arrangements. I'll then hand over to Mark, who's going to talk to the taxing of sweat equity arrangements and company valuations for the purposes of the discussion as well. I'll then briefly touch on what you need to consider from a legal compliance and documentation perspective. And then we'll run through various examples of sweat equity arrangements that we commonly see, as well as discussing some common sort of current trends that we're seeing in the space before moving on to that Q&A session that I discussed. So, what is sweat equity? So when we're talking about sweat equity, we're basically talking about the issue of equity in consideration for contribution to a business through effort, time and skill. Now, these arrangements can help secure the delivery of certain services or attract key talent when cash resources are tight, offering those providers effectively a stake in the company instead of or in addition to cash payment. Now, in doing this, the benefit is you're aligning the interests of your service providers or employees with the owners of the business, which encourages shared goals of growth and profitability. Now, in the startup space, it offers also potentially the opportunity to be part of a high potential venture that could disrupt the industry. You're potentially looking at hopefully a very valuable stake in the business in the future as a result of them. Now, they're typically used by early stage high growth startups for the sole reason they've got limited cash reserves, but we do also see them coming into play in family businesses, sometimes as part of succession planning, as well as larger enterprises as well. So hugely flexible in terms of the breadth of use. Now, it is really key to understand the legal requirements and the tax implications of these arrangements. Of course, we're going to say that, but it is a genuine comment, and make sure that you're structuring them properly before you start. So, for example, you're thinking about things like, are you offering this as a one-off arrangement to one key person or service provider, or do you intend to offer it to multiple people? You should also be thinking about things like, what's the purpose of the sweat equity? So is it being offered as a sweetener on top of market standard consideration and rolled out to lots of people, or is the intention that no cash is going to be passed over to that person at all, with these arrangements being the entire consideration granted? So being clear on all of those aspects and the background and the purpose of the sweat equity arrangement will dictate the documentation that you need, and also will help inform how you most effectively structure the arrangements as well. So talking to the different forms of sweat equity, we're going to be primarily talking around either the issue of new shares in the business or options, which will later be converted into shares. Now, that is a really critical distinction. So issuing shares will mean that that person will have an ownership percentage immediately, which will typically mean that they can attend shareholder meetings, they'll receive dividends, and a portion of the proceeds on exit. Now, conversely, if you're issuing options, that means that you're giving that person a right to receive shares at a later point in time, and often that's not going to be until there is actually an exit event. So option holders typically will not have the same rights as shareholders, but they will benefit from a portion of the proceeds on an exit. Now, I wanted to touch briefly on phantom share and profit share arrangements in the context of this discussion as well. They're typically seen to be kind of sitting outside the true sweat equity arrangements in terms of optionality, but they are particularly important to consider, particularly as Mark and I will soon kind of dive into the interplay of the commercial intent of these arrangements as they tend to butt up against the tax implications. Because these two options can actually be quite valuable in certain circumstances. So talking to them really briefly, they are quite similar concepts. With a phantom share scheme arrangement, it's basically a contractual agreement. It gives the person the benefit of share ownership without actually issuing real shares. So they'll receive these phantom shares, which effectively mimic actual shares, including the value of the actual shares. They are useful for private companies who want to issue or provide kind of share-like incentives without actually diluting actual ownership. Now, a profit share arrangement is where the holder will receive a percentage of the profit, self-explanatory, and that's often in addition to their base salary or compensation, and it's usually paid out on sort of a quarterly or an annual basis. And it can be structured as a fixed percentage or tied to specific performance metrics. Now, in comparison to a phantom share arrangement, it doesn't provide exposure to the company's growth and value. Now, obviously for both of those, the reason I'm raising it, as I touched on before, is that they still help align that person's interests with the company's success, but they are more straightforward than an equity arrangement to implement from a legal perspective, and they can have some tax benefits as well. Now, for the purposes of this webinar, we'll obviously primarily focus on the shares and options. So what we've set out on the screen now is some of the critical structuring considerations that you do need to canvass quite thoroughly before making any offer of sweat equity. Now, I'm going to be primarily talking to them from a legal perspective, protection of the company perspective, but as I'll touch on before I hand over to Mark, you obviously can't consider them in isolation, and you do need to overlay that with the tax implications of each of these kind of considerations. So when we talk about shares as opposed to options, I obviously spoke briefly earlier around the difference in the rights that are attached to each of those. What you also need to be considering is the situation. So have the services already been provided? That would presumably be on a trust or handshake basis during the early stages of growth. Effectively, what that means is the equity has already been earned. If so, then issuing shares up front probably makes sense and is appropriate. On the flip side of the coin, it might be that the sweat equity offer is being made to actually secure that person to provide the services. It's being offered when they sign up with the company, so it still needs to be earned. And from a legal perspective, typically in that scenario, options are more appropriate. Now, as part of that kind of decision around shares versus options, you need to be thinking about potential vesting arrangements, which is the concept of earning the entitlement over time to make sure that that sweat equity isn't issued, and then the service provider just walks away retaining that entitlement. So typically you'd attach the entitlement to time. So you work in the business for a certain period before you benefit from it, or it might be attached to certain KPIs. Now, if you go down the KPI route, it's really critical to make sure that they're really clear and measurable KPIs to make sure that you're preventing any potential confusion in the future. Now, vesting arrangements, they'll effectively limit the financial benefit initially, and the idea there is if they're not earned, they can be cancelled or bought back for nothing. So they can also be applied to both a share that's issued up front and they can be applied to options as well. But it's a bit more of an involved process to buy back or transfer shares that have been issued and not vested than it is just to simply cancel options. So that's just worth keeping front of mind. The next point there that I've got is it's important to clearly document what the expected sweat contribution is. So that would be your employment agreement, your contractor or service provider agreement. So it's setting out the terms of what you're expecting them to give. It obviously makes sure that as soon as that person is not delivering the expected service, the expected sweat, that entitlement then falls away. Now, you need to really carefully consider the trigger for that termination. So is that they didn't deliver the KPI within a certain time frame? Is it the last date that they're employed with you? Is it the date that they hand in their notice? Or it might just be it's when the board decides that the services aren't being delivered in accordance with the expectations. So lots of different nuances there in the drafting. The other key, I guess, flag here is that often we've got clients that come to us and say, we've promised to give 5% to this service provider. What we'd always recommend is documenting the number of shares or options that are being given as well as the percentage. The risk with just doing a percentage and agreeing a percentage in principle is it raises a lot of questions. So, is that 5% on a fully diluted basis? So after conversion of that entitlement and any other convertibles, or is it 5% of the current share capital, which will mean that when it's issued, they actually hold less than 5%. So by actually documenting the number, you're making sure that there's no confusion there. You're also making sure that that entitlement gets diluted in the same way as all of the other shareholders and security holders in the company if you do have a capital raising event in the future. Now, the final point I just wanted to raise here was this right to repurchase. So I touched on it in the context of vesting. So the idea of being able to repurchase shares at a nominal amount if they've not vested or been earned. But you should also be considering whether you want that right to repurchase to apply to vested shares or options. So they've already been earned, but that person leaves the company or they stop providing the services. Often what you'll want to do is that even though they've earned that entitlement, you don't want them to continue to benefit from the uplift in value in the company after they've left. So you'd have an ability to buy that entitlement back at fair market value when they leave the business. It also then kind of allows the company a little bit more headroom to offer equity for, say, a replacement person if that's a really critical role. So as I flagged on the slides and earlier, they're very much kind of, it's a sprint through of the things that you need to be talking about or thinking about when you're structuring your sweat equity offer. But you obviously can't consider it in isolation. So obviously the key purpose of this webinar is then to talk about, okay, well, those are the legal structuring considerations or commercial considerations, but actually what are the tax implications of the offers? Because that's really critical to ensure compliance with the IRD, but also to ensure that they're structured in a way that remains attractive to the service provider or employee. So Mark, I'll hand over to you to discuss the tax position.
Thanks, George. Okay, all right. I've got a slide, so we'll start with the slide then. But look, when we talk about sweat equity, we talk about from a tax perspective, we're looking at two distinct types of persons: those who are employees, and we have specific rules, and those who are contractors. We don't necessarily have specific rules there, but we do have guidance from the commissioner that the commissioner considers that there's a barter transaction. I've given up time, well, it's similar to an employee. I've given up time and service, and I've been rewarded in the form of shares. But I think before we go into the next slide, it's important to pick up some of the things that George has said. So these rules for employees, they were revised around 2017, 2018, and there was quite a lot of hoo-ha as to the rules were largely being ignored. So sweat equity was all well and good, but nobody actually complied. The law and the Commissioner's position has very much been tightened up since 2017-18. We have a vast number of guidelines, but I think importantly, useful to remember, always useful to remember, you should drive from the commercial hip. And unfortunately, from a tax perspective, you can't always have your cake and eat it. So as George said, we like sweat equity for many number of reasons commercially. It allows our employees to share in the upside of their exertion in the future, and we don't have a capital gains tax here. It allows us to reward with other than cash when we don't have any cash. We like to lock people in. We like them to earn the sweat equity effectively by locking them in. All of these things that we wrap in from a commercial perspective can fundamentally change how the Tax Act will see it from a tax liability perspective. So if we go to the next slide, so I can remember, please, George. So very, very broad rules. Options, we do care about them, but we don't care about them. The issue of an option from a tax perspective, so I will give you the option to acquire shares in the future. The issue of the option in itself doesn't create a tax liability. It's the exercise of the option and whether or not we've got any fancy hurdles, etc., around it, which will trigger the tax. So the issue of an option isn't our taxing event. It's where we acquire shares fundamentally for less than market value. That's our trigger point from a tax perspective. The question is, next slide, please, George, is at what point in time do we acquire the shares for tax purposes? And it can be different to how we might ordinarily perceive it from a legal perspective. So what we care about for tax is that the employee owns the shares, has beneficial ownership of the shares in the same way as any other ordinary shareholder. So if it's free of KPIs, free of hurdles, free of good leaver, bad leaver policies, etc., and they paid market value, there's no lock-in, then the time they've acquired them for tax purposes will be the time they acquired the shares, whether for market value or otherwise. If they acquired for less than market value, then that will result in a tax liability, which we'll get to. So the date of acquisition, which is referred to in a very special technical term as the share scheme taxing date. As I mentioned, we care about, and these are the ones that we see a lot, we care about schemes with strings attached. So if we have a good leaver policy. So for example, I've put aside $10,000 worth of shares in trust for an employee. The employee will receive those shares if they stay in employment for 3 years. If they are prevented from employment because of death, disability, redundancy, illness, etc., they'll get those shares then as well. That good leaver policy means that the share scheme taxing date doesn't arise until the earlier of the passing of the 3 years when we lift. You only get the shares after 3 years, or if one of the trigger points occurs, i.e. disability, illness, etc. So good leaver policies can defer or delay the share scheme taxing date. And in this example, it would be until 3 years has lapsed when the employee can hold the shares in any way any other normal shareholder would. Bad leaver policies. So if you have a bad leaver policy that says you can acquire some shares, and if within the next 3 years you are disciplined and removed from employment due to misconduct, and have to forfeit those shares for nil consideration, the Commissioner's view is that that isn't a material enough event to cause a deferral. So the share scheme taxing date in a bad leaver scenario is the point in time in which the shares are held by the employee, assuming there aren't any other hurdles to jump over. If you don't have if the employees aren't entitled to dividends, if they're not entitled to vote, all of those types of things would mean that the share scheme taxing date is deferred. Schemes with no strings attached, and I'm referring here to loans that don't really have to be repaid, that's one which crops up more often than not. So what this is doing is this is protecting an employee from downside risk. So for example, if a company loans an employee $1,000 to acquire some shares, and at the end of the year, the loan is required to be repaid. If the shares have a value less than $1,000, then the shares are sold to the employer company for $1,000, i.e. the employee is protected from the downside risk. If, for example, after the end of the year, the shares are worth $1,600 and the employee keeps those shares and repays the loan, then the rules will say that the taxable income is the difference between the $1,000 paid for the shares and the market value at the point in time the loan is repaid, i.e. $600. So loans that don't have to really be repaid can be a problem in that share scheme taxing date, or can defer the share scheme taxing date. Now, if we talk about market value, and I'm not a valuation expert, but market value is quite important, because the employee share scheme rules are both an art and a science. The science is around the share scheme taxing date, etc., and the art is largely around, well, what's the market value of what we're either receiving or paying for? The Commissioner has various guidelines, and we'll jump into a bit more detail depending on whether the entity is listed, unlisted, or an unlisted startup. But fundamentally, we are looking for a market valuation that conforms to a form of acceptable practice, which is driven by, and this is where I am not a valuation expert, but an advisory valuation standard hidden within the Chartered Accountancy rules. Also takes into account either future cash flows, future income, present value of assets, etc., and is fair and reasonable. So that's a very broad art in what the Commissioner is looking for in terms of the market valuation. And I think we're going to get to more of the detail in a bit. But if we're understanding the tax consequences from the employee's perspective, and this is where I think you've got to be really, really careful, and we'll get to it in the fourth bullet point. But first off, tax consequences. If the employee has received the shares from a tax perspective and they paid less than market value, then we have an income tax liability. The next question is, who pays? The employer has the option to pay the tax liability through the PAYE regime. So the employer company can choose to pay the tax liability on behalf of the employee in the same way as you ordinarily would for a cash payment. There is also an obligation for the employer to make disclosure, and this is where the rules were really tightened up. So you could just ignore the rules or assume that there is little to no market value in a share scheme company. But now there is notification to the Commissioner for employee share schemes. If the employee is the payer of the tax liability, then we need to consider, does that mean they've got future provisional tax consequences, which can be quite a pain and very easy to miss. Now, this is The fourth bullet point, as well as talking about before, is where you've got to be really, really careful. What are we really trying to achieve here? Because the employer company gets a tax deduction equivalent to the taxable income of the employee if there is taxable income under the employee share scheme. So that means what we're really playing around here with is the difference between the marginal rate of the company, 28%, and the marginal rate of the employee, which might be 33, might be 39, might be less. Who knows what it will be? Normally around that 33, 39. So what we're really playing around here is with that 11% differential. So really think about that in terms of your decision making. What are we really trying to achieve here? Is it worth it? The employer company also receives more available subscribed capital. So that's effectively just the share capital that a company gets on issue of shares. And that's to make sure that it's equitable and effectively, overall, the employee share scheme rules will mirror the position as if the employee received a cash bonus. So if the employee got a cash bonus, the employer company would get a deduction. That makes sense. And then if they then applied it to acquire shares, the employer company would receive share capital. So these rules are mirroring what the actual unraveling the barter in this case. Sorry, George, next slide, if that's all right. There was a small change to interest-free loans recently. I think might have been, I want to say March this year. But fundamentally, an interest-free loan made available to an employee by an employer and not subject to FBT. But this is providing we meet all the criteria. The criteria, you must have borrowed the money to acquire the shares. You must have used it to acquire the shares. The loan must be repaid if you're no longer a beneficial owner, i.e. you exit the shareholding. And you must have a dividend policy that's maintained if that's the case. The slight change here is that the Commissioner has acquiesced in that the rules used to be applied such that you would only get the concession from FBT if the loan were interest-free, providing the employee held the shares in their personal name. The Commissioner has now moved to we can hold in a trust for the benefit of the employee and avail of this concessionary treatment if that's commercially what you want to do. So not subject to FBT. Sorry, George.
Mark, just before you move on to the situation of contractors in comparison, obviously there's many things imperfect around the taxing of employee share schemes. I know that there's a law change coming for tax exempt schemes. Now, we don't typically touch on it with our clients because it's mainly those tax exempt ESOPs are largely mostly beneficial for things like listed companies or companies with lots of employees. So normally it's not really an option for our clients, but they have made some changes in terms of lifting some of the monetary thresholds there. And obviously in Australia, they've got some really favourable startup tax concessions for ESOPs. Do you anticipate, or is there any kind of word or murmurs out there that the rules around employee share schemes, particularly for startups, are going to change to try and be a bit more favourable to employees from a tax perspective?
I haven't heard anything other than we are fiscally constrained. So in an environment where we're fiscally constrained, I'd be surprised to see anything drop out that moves towards a benefit that reduces the income tax take. No, I haven't seen anything, and nor do I expect anything. But perhaps, George, I have to eat my words if indeed it comes out.
I'm sure you'll have some very happy listeners if that does happen.
Contractors, the sweat for shares, it's essentially, it's not really too dissimilar, other than we don't have those specific legislative rules as a backstop. However, the Commissioner, and I think this was in the 17-18 guidelines, I think the Commissioner mentioned don't forget contractors, i.e. those that aren't employees. Look, at the end of the day, what we're doing here is we are swapping cash for something else, which I think, actually, I won't even go there. Swapping something for cash, we're swapping cash for shares. If we had received the cash, it would have been subject to income tax. We would have had a GST liability if we're GST registered. And the rule here, or the advice is to honour the barter. Make sure you gross up, because of course, if you've got the shares, that's the net receipt. So from an income tax perspective, you have a higher amount. Similarly for GST, the big question is what's market value, which is exactly the similar question for the employee situation. George, do you want me to drop into market value, or do you want to do it later?
Yeah, I think so. Look, we've had quite a few questions coming through. Obviously, a lot of people that are struggling with, well, we're a startup, we're early phase. How do we attach a value to our company? And if you could touch on, if there's any kind of methodologies that they can look to, or any guidance they could look to, that would be really helpful.
Yeah, directors can be employees. I think that's something that's come through, and I think it's they refer to specific shareholder, employees, etc., and directors refer to specific sections in the Act. But I think a director is an employee for this purpose. But in terms of market value, the commissioner looks at three distinct types of entities. So you have your listed entities. Listed entities, very easy to work out market value, and the way that the commissioner has provided guidelines here is to look at the volume weighted average price of listed shares over a 5-day period. So very easy. Listed entities, we've got the information readily to hand. We look at it. We do an average over 5 days. Unlisted entities. So unlisted entities. The first thing that we can do, option A, I think it's referred to, is if we just get an independent person external to the company that is equipped and skilled in undertaking company valuations. So that's our first step. Second step is that we can look to externally driven valuations, i.e., I've got a company, and in the last 6 months, I sold some shares to George, and George paid $1,000 for those shares. That's the value. So George acquiring shares in my unlisted entity as an external person within the last 6 months, that gives me a point that I can value the shares from. So external capital raises, they're a good indicator. The third one is undertaking an internal valuation. You need to have a competent person that can do it. You need to be able to document why they're competent, and they need to have due regard to, again, using an acceptable valuation. And I think the commissioner refers to discounted cash flow or future income generation. I don't think the commissioner likes net asset, because of course, if you're I'm not even sure if you worked on a net asset position, it would have a valuation. So net assets to value the entities are not often looked at favourably. The last one is your startup. Your startup unlisted is essentially the same as your unlisted, except the 6 months rule for external capital raise is increased to 12 months. So if there's a 12-month either side, then that will drive your valuation. It is almost I don't know, I'm not a valuation expert, but startup unlisted, you're largely valuing. There's a bit of a dream in there, and as I said, it is an art, not necessarily a science. But those are the guidelines that the commissioner has put forward. If you are taking a view that there is either nominal or no value in your startup, then just make sure you can substantiate that with good practice.
And that leads on to one of the questions I had, Mark, with the concept of there being nominal or no value in the company. Often what we see is that the startup founders are thinking, well, I haven't got my first customer on board yet, so there's no value to this company. But they might have been working on their service, their product for 2 or 3 years. They've trademarked certain aspects of it. They're ready to launch. What's your view on them saying, well, actually, and being supporting that kind of perception that, or that opinion that they've got no value at that point in time?
I've got to be careful, George, because I'm not a valuation expert. I'll be dropping back to what the commissioner says in terms of the guidelines. Um, it's not for me to value it, but it's for me to outline what the commissioner considers is an acceptable approach in valuing the company. But as with everything, plucking a number out of the air because we're early and about to launch, without substantiating it, showing you're fair and reasonable, demonstrating that you conform to acceptable practice, isn't going to hit the mark.
And that also, the overlay to that as well, is obviously this is coming down to a board decision in terms of at what value effectively you're issuing those shares. Your directors are going to have to certify the fact that they're being offered at a fair and reasonable terms to the company and its shareholders. So I guess the legal overlay to that, as well as that the directors need to keep front of mind their director duties under law as well when they're doing that too. No, that's really helpful. In
Yeah.
terms of option one, Mark, if, again, if we're talking to a cash-strapped business, don't want to unnecessarily spend, but they don't have anyone internally that's got the capabilities to set that valuation. How much, again, this might be how long's a piece of string, but how much would they be looking at to get an external party to help them determine what the valuation is and give them the supporting information, or help them determine a valuation methodology to use going forwards?
I don't know how much it would be, George, but I think with all of these things, it's a very good idea to explain the background facts to the person that you have chosen to undertake the valuation, and then ask them for an estimate or a quote of what that cost would be. Yeah, very very difficult to because I mean, without specifics, it's almost there's all sorts of things that will come into evaluation. Are they offshore, onshore? How many employees? Is it tangible? Is it intangible software code, etc.?
Yeah.
But I do have to be careful, George, because my job is in tax. Not I
I
can't.
want
Yeah,
specific answers and
yeah,
valuation, Mark.
yeah,
No, look, totally appreciate that. It's just nice to get that opinion,
yeah,
because obviously it feeds into the tax piece so
yeah,
closely.
yeah,
One thing that we often advise as well is, if you're in a situation where this isn't a one-off sweat equity offer to the key service provider or whatever it is, if this is being done as part of an ESOP, what we typically recommend our clients do is that they have an exercise window. So, assuming, obviously, with the context of Mark's comments earlier around when that trigger date is for the taxing event, assuming that's on the date that you exercise those options into shares, what we recommend clients do is they have an exercise window, which is an annual exercise window, which means that the company only has to assess the valuation once a year. Because obviously, if it's not a perfect science, if you're not regularly raising capital, that actually can be quite a onerous exercise for the company to do, as well as being at risk for the directors in terms of landing on that valuation. So if we can limit it to an annual assessment, then that just makes it a lot more streamlined to roll out these
yeah.
arrangements going forwards.
Yeah, and I think it's important also to note that when you're, just so that we don't lose it, when you're undertaking a valuation, the commissioner considers it is acceptable to build in a discount for liquidity, i.e., the shares might not be readily traded or sold, and or control. So a 1% shareholding is going to have a very different valuation to 26.
That's interesting, yeah. Talking about discounting, we've had a question that's come through. It's also a scenario that I see quite often where, as part of a capital raise event, the company is agreeing with certain key employees or service providers that they will be issued some sweat equity at the same time as that capital raising event, where obviously you're getting an external party that you've negotiated a valuation with. Often what they're trying to do is apply a discount to that sweat equity arrangement that's being issued at the same time. What's your view on that? What do they need to be aware of when they do agree those sorts of arrangements?
Well, you'll start from the top down. So the starting point will be what did you offer external parties as part of that capital raise? And that, to my mind, is that's your market value. And then the question is, in terms of an appropriate mechanism to value the shares going to the employees, is it reasonable to build in a discount, for example, for control? Because I assume that there is already a discount built in for a liquidity event or liquidity for the external party already. So that, to my mind, is probably largely discounted. But the control element, perhaps not. But your starting point is 100%. What did you offer to external parties?
Yeah,
And
absolutely.
what did they accept?
That makes sense.
Yeah, yeah.
Okay, cool. I know that we've sort of dived into a few sort of example situations, but it sort of naturally lends itself from this conversation. So the other scenario that we often see is we get a lot of companies that will undergo a corporate restructure. So they're inserting a holding company. It might be a requirement of an investor. It might just be that they're recognised internally they want to do that. Or we have situations where there's 3 founders, and they've decided that they got it horribly wrong when they incorporated the company in terms of the split of equity as between themselves. And they want to effectively just rejig the arrangements. Now, in terms of that, they're not intending to transfer cash as between themselves. They just want to effectively restructure what they've already got. Obviously, if we are not in the first early stages of the company and the business itself, that is going to presumably trigger tax consequences. What's your recommendation, or how would you suggest that they go about that to effectively rejig things to get themselves back into the position that they actually wanted them to be in?
Well, I guess the question is why are we rejigging? We got it horribly wrong, but why did we get it horribly wrong? Was it just a mistake, or is it because one party's doing more work than the other? And that will drive how you're going to determine the tax position. Very hard to unravel and say, oh, we just made a mistake. That looks like regretted choice, and the Commissioner doesn't like regretted choice as a rule. Just as an offside, just be careful with holdcos. It's not for today's conversation, but they tend to be very careful. There's anti-avoidance legislation around dividend stripping and holdcos. Not for today, sorry. I'm just chucking it in there.
No, good to know.
I think with all of these things, the recommendation is that you seek advice at the right time and just acknowledge the rules that are out there. If you're doing a rejig because somebody's worked harder than somebody else, then it's starting to look like something that's going to be taxable. If you're doing a rejig because we just got it completely wrong and that was never what we intended, that might be a different outcome.
Yeah, that makes total sense. Well, look, we're obviously running out of time. So I think it's probably worth me quickly touching on just the legal considerations as well, which obviously needs to be overlaid here too. So in terms of what you need to be thinking about here, and again, it goes to that getting advice up front so that you can make sure that you are ensuring compliance before you enter into any of these arrangements. But the key things to look at are the Companies Act, which is going to inform what approvals are required, what process the company needs to take, the director duties that apply when they are issuing any kind of sweat equity arrangement. The really critical one from my perspective is the Financial Markets Conduct Act. So any security that you're offering, whether it's a share or an option, there's usually really extensive disclosure obligations that apply when you're issuing any security, but there are exemptions that you can apply. Often businesses will be looking to those exemptions and rely on them when they are offering sweat equity arrangements. But each of those exemptions has their own specific compliance requirements. So again, get some advice, make sure that you're complying with them. It's worth touching on it, given we've spoken a little bit about ESOPs. There is a specific ESOP exemption, but there is a particularly strong view that actually the ESOP exemption is not relevant or not appropriate when you are offering a true sweat equity arrangement, i.e. there's a real salary sacrifice happening because the company is cash strapped. Effectively, that's raising funds via OPEX reduction. That's the primary purpose of why you're offering that. And so suddenly we move away from that requirement of the ASOP exemption, which is that you're not doing it for the purposes of raising funds. So in those situations, we do recommend that you're picking and choosing from the other exemptions that might apply. But again, careful assessment required. You also need to be considering your own governance documents. So what does the shareholders agreement say? What does the constitution say? Often when you've got external investors, you might have some decisions like issuing sweat equity arrangements or issuing any kind of security that needs an added approval from, say, an investor director or the investor majority. So it's just carefully working through those three aspects and how they interplay with each other and making sure that you're getting the right approvals in place before you issue them. Now, I won't dive into the documentation piece too much. That's all a bit obvious, but the key one there is the clearly setting out the sweat equity contribution. So you need to have that service provider agreement in place, the employment agreement in place to make sure that you are interlocking the right to ownership with the services that you're expecting that provider to give. So we have managed to obviously build in some of the case studies and also our Q&A that's been coming through from everybody in the audience. So thank you for your engagement on that front. It's always great to see. If we haven't answered any questions that you have asked, please do reach out to us. We're more than happy to talk through those in a consultation. I've just put up on the screen basically a ability to download our startup manual. That's available for you if you are interested. We've also got our next webinar, LegalVision webinar, which is Buying a Business, it's a 101. So if that's of interest to you, then the sign up link is there. We've got some membership information. I know a lot of you have already had a lot of engagement with LegalVision already and know a lot about us, but basically if you are interested in LegalVision membership, then please do reach out to us and let us know. We're more than happy to talk you through that. But more importantly, obviously Mark's details. He is a tax specialist, so please do feel free to reach out to him direct if you do want to get some tax advice on your specific arrangements. Be sure not to ask him to value your company, but I'm sure he can send you in the right direction if appropriate.
Correct.
So look, I feel as if it's been a very quick sprint at the end to try and close this within the agreed time. But look, it's been a really great discussion with you, Mark. So thank you very much for your time. And to the audience, thank you also for your engagement. Hopefully we have managed to embed your questions and queries throughout the discussion today. But obviously lots more nuances and discussion to be had. So please feel free to reach out to either Mark or myself if you've got any questions. So thank you, Mark, and thank you everyone for attending.
Thanks, George. Thank you. Bye.